Yeah. Good morning, ladies and gentlemen. I give quite a couple of presentations over the year, and I can hardly imagine that I ever had a welcome note by a chairman which was such a good introductory to my presentation. I like to speak, of course, about the state of the US economy. And of course, I like to speak about what actually happens in Europe. When I spoke at this conference in Munich 2 years ago, we were pretty much concerned about the situation in Europe. We were concerned about Euro might break apart, and I can tell you I participated in a telephone conference with a German supervisor where all German banks were asked to be able to provide trade in intra-European currencies within 3 days. So we promised to be able to trade Deutschmark against Italian lira within 3 days and to provide all the hedge products within 5 days. So the situation was indeed very severe. And of course, it's worth to have a look at what actually happened, what actually changed. Where did the problems just disappear, or is there a price to pay for that? What did the ECB actually do, or actually did? Two things I would really like to cover. First of all is what is actually going on in the United States. Chairman Marty already mentioned the very good numbers we received on Friday. Economic growth of 4.6% annualized. That's a strong number. That's definitely far above potential growth in the US. And of course, this is an argument for the Federal Reserve to hike interest rates, but I still have a question mark behind hiking interest rates. If you look at the Fed actually got two targets to tackle. One, of course, is to provide price stability. So they aim for an inflation rate of 2%. But in contrast to the ECB, the Fed has a second target, and that's what they call maximum employment. So they are also responsible to provide stimulus for the economy, to make sure that the labor market doesn't have too much overcapacity. So if you ask FOMC members, they would tell you that 5.5% in the unemployment rate in the US, that's the target where they are aiming for. And now we can combine these two targets, and I try to do that with these chart. You can see on the vertical axis you've got the inflation rate. So there the target is 2%, and on the horizontal one you've got 5.5% unemployment rate. And you can see that in the pre-recession period, we were pretty close to these overall target. These are the yellow movement. And then we had this severe recession, and of course, we know what we saw is that the unemployment rate increased significantly. This is this way here. And in the post-recession period, after a while, we are now back to this point, and well, this is pretty close to our perfect target. So if we just look at inflation rate and unemployment rate, we would say, yes, the Fed should normalize its monetary policy quite quickly because the stance of the US economy is pretty well. But there are always some concerns. If you listen to Fed chairwoman Janet Yellen, she's always talking about slack in the economy, slack at the labor market. So she's not totally convinced that the FOMC needs to hike rates immediately or in the very short term. So what are her concerns? She's talking about two things. The first one is the increase, the decrease in the participation rate. Participation rate is just the share of the workforce which is employed or unemployed. Yeah? How many persons in the US are actually taking place in the labor market? So this is the participation rate. Currently, just over 62% of the American people in between 16 and 80 are either working or looking for work, even if they are unemployed. So this is the participation rate. And Janet Yellen always argues that unemployment rate just came down because the participation rate decreased. And this is a bad sign, because it would mean that the US economy is not generating its full potential. I don't think that this argument is valid for two reasons. First, if you look at this participation rate, it goes up, and this is the situation Mrs. Yellen is always talking about. But look at the time scale. It starts in 1960, and now we are at 2014. So if the drop in the participation rate would be a cyclical problem, our economic cycle would be about 50 years, which doesn't really make sense. So just looking at the participation rate, you can see it doesn't look like these are cyclical reasons which just lower the participation rate. And of course, I wasn't the only one looking at this picture, and we already have an analysis provided by one of the regional Federal Reserve Bank in the US, and their finding was that especially from this point on, the drop in the participation rate is due to demographic reasons. So it's not a problem of monetary policy. This is a demographic problem, or it's not a problem. It's the reason behind it. So the fall in the participation rate cannot be healed with a monetary policy because it's not cyclical. So the first argument Mrs. Yellen usually uses is not valid in my opinion. The second one, the story goes like this. The unemployment rate is just coming back so strongly because people are so disappointed. They are discouraged. If you don't expect to get work, you don't claim that you're unemployed. You just stay on the side and you are not participating at the labor market anymore. So the question is the drop in the unemployment rate just due to the problem that people are discouraged? Now, it's very easy to prove that this argument is also not valid, because the Bureau of Labor Statistics in the US provides a second unemployment rate. So here we've got two unemployment rates. The red one is the official unemployment rate we are talking about. The one you know, it's at 6.1% currently. Now, the orange one, which is always a bit higher, is an unemployment rate which includes discouraged workers. So these unemployment rates are provided by telephone interviews. And if I'm the Bureau of Labor Statistics and I call you and you tell me, well, I'm unemployed, I will ask you, are you unemployed or you don't have a job? Are you discouraged? So if you tell me, yeah, I think I don't have a chance to get a job, so I don't even claim for it, I would call you, I would count you as an unemployed. So all discouraged workers in the second data series are counted as unemployed. That's why these unemployment rate is obviously always higher than the official one, because it's not possible to have a negative number of discouraged workers. But what you see, and that's the most important point, is they are moving pretty much in line. So if the drop in the official unemployment rate would just be due to discouraged workers, we would expect the discouraged workers want to trend sideways. But it falls. It falls with the same speed than the official one. So the drop in the unemployment rate in the US is not due to discouraged workers. So all these arguments we hear from various FOMC members about slack in the labor market, sorry, I can't find it in official numbers. These are official numbers. So from that point of view, it's time for the Fed to hike interest rates. It's time for the Fed to normalize its monetary policy because the state of the US economy is pretty good. Now, what about financial markets? I analyze FX rates for about 20 years, and so of course, if we expect that the FOMC would hike interest rates, that's a strong argument for a stronger dollar. But the main question obviously is, if everybody expects the FOMC to hike interest rates, that should be priced in at financial markets immediately. So an interesting question is, how much of Fed policy normalization is already priced in? Well, in the US, it's very easy to get an idea what the market expects for the key rates, because we've got a future, a Fed funds future in the US. So that's a future which is just trading the future monetary policy key rate. And this is the yellow line. So you can see that the financial markets expects the Fed funds rate to increase, but only to a very small extent. And this funny thing on the right-hand side here, these are the expectations of the FOMC members. So these are the expectations of this people who actually decide about the federal funds rate. And twice a year, they are asked what they expect. So for the end of 2015 here, some of the FOMC members say, well, to remain at 0.25% would be appropriate. And that's what we expect. One, Mr. Charles Plosser, he expects even 3%. So I skipped him here because it's an outlier. But there are some expecting 2.5%. And what you can see here is a quantile. So what we see is here, these are the first 25, the lower 25%, second 25% of FOMC members. So in fact, we see that about 75% of the FOMC members expect higher interest rates at the end of 2015 than the financial markets. So the conclusion is that there is not much priced in regarding Fed policy normalization, which also means if it really becomes obvious that the FOMC will hike interest rates, there is still room for more US dollar strength. And the latest decisions by the FOMC made clear that these quantitative easing, the asset purchases, they will stop at the beginning of November. So that will be history. And now the question is, how much time will be between the end of the QE program and the first rate hike? And of course, if the market expects this to be 1 or 2 years, it's such a long period that, well, there is still a risk that something might happen in between so that they won't hike at the end. But if it comes very close, then the risk is very, very small. So market will be pretty sure that there will be rate hikes towards the end of the year, and that's why we expect that this dollar strength will continue. So regarding the US economy, this summarizes a strong economy. Of course, they will have higher rates, and it's not priced in yet, so more US dollar strength. Now turning to the ECB side. Chairman Marty already mentioned that this situation now is much better than what we saw 2 years ago. Yields in the peripheral countries are lower, volatility is very low. Well, economic growth could be better or could be even much better, but we are not heading towards recession. And don't forget all these geopolitical problems. They are also dampening growth at the moment. So if there might be some improvement, we can expect the economy to grow a bit stronger. And that's why the forecasts for 2015 are higher than the ones for 2014. But an interesting question is, what actually happens to these problems? I mean, we were afraid that the Eurozone might break apart, and now nobody is even talking about it. I mean, the euro is not very strong currently, but this is also something the ECB seems to like. So, what actually happened? Well, first of all, the ECB did quite a lot. Just to summarize, I mean, so much happened that sometimes it's just good to recap what the central bank did. We had full allotment. The ECB started with full allotment. That means banks can get as much liquidity as they want. That was a quite new situation. Lengthening of lending maturities. Remember these first 3-year LTROs. We have a permanent emergency liquidity system for struggling banks. That means, let's say, this broadening of collateral acceptance means today the ECB accepts almost every collateral. But now let's say we've got a bank in a certain country which does not even have this collateral which is required, this weak collateral which is required by ECB. This bank can still get liquidity from its own central bank. And that's called emergency liquidity assistance. So a German bank could get money from Bundesbank, or a Greek bank from Bank of Greece, or whatever. So then we had the first security markets program. That was when the ECB started to buy Ireland, Irish, Greek, and Portuguese bonds, and at the end they bought also Italian and Spanish bonds. We have the outright monetary transactions promise. That is actually something where Mr. Marty talked about. That was the famous speech of Mr. Draghi in London, when he said, we will do everything to preserve the euro, and believe me, it will be enough. That was just the promise, and in a couple of minutes we have to talk about what actually this promise is about. Well, then we had zero interest rate policy. The ECB started with a forward guidance. I can remember we always look at the ECB press conference, and of course for a couple of years almost at every conference and the Q&A session, the same situation appeared. That was, a journalist asked Mr. Draghi, what are you doing next month? Is it a possibility that you might hike or lower rates? And he always answered in the same way. He said, we do never pre-commit. And to be honest, he did it in an almost not very nice way to answer these questions. I couldn't hear it anymore. And from one day to the other, he didn't answer, we do never pre-commit. He actually said we do pre-commit, because he provided some forward guidance promising that the ECB will keep rates very low for a very long time. Well, then we got negative interest rate policy. Banks have to pay for their deposits at the ECB account now. The security markets program isn't sterilized anymore. And the last thing was the targeted LTRO. Banks can even get money for 4 years. And we had a very close look at it. It's not really targeted. If you want to get the money, you can get it. So it's not targeted. ABS purchases. They talked about it a lot in the last press conference, and we actually can put it to the top side here. So the last possible measure is actually quantitative easing. So remember, the Fed just stopped this quantitative easing, and in Europe, quantitative easing is the last measure the ECB would be able to adopt. Because all this worked, had some implications, but it seems that the ECB is not really satisfied with it. So that's the arsenal of the ECB, and there are just some few bullets left. By the way, this is Arsenal London, of course, for them. Where is the ECB concerned about? Well, the ECB is concerned about, the only target I already mentioned is price stability. So the ECB is aiming for an inflation rate just below 2%. And of course, the central bank does not only look at the current inflation rate, it also looks at inflation expectations. This is very important. Are inflation expectations well anchored? That's a question which is tackled at every press conference. And here you can see the inflation expectations the ECB looks at. This is derived from inflation swaps, and it's the inflation expectations in 5 years for 5 years, so a very long period. And the first time when Mr. Draghi mentioned that quantitative easing is something which might be a distinct possibility also in the short term was here, at this point. After the drop in the inflation expectation, he said, we are very concerned about this inflation expectation movement because inflation expectations are not well anchored anymore. And then he talked about quantitative easing, and you can see that inflation expectations went up again, this point. And at this point here, this is exactly the last ECB interest rate meeting. Because what the ECB actually did was they once more lowered interest rates, but they didn't provide any quantitative easing. So if you look at inflation expectations, they dropped once more. My conclusion is Mr. Draghi talked about quantitative easing. Now the market is demanding quantitative easing. So that was just a disappointment for the market. So this would be an argument for the ECB to implement quantitative easing. Because in that case, when the inflation expectations drop severe, quantitative easing would be a monetary policy measure. That's very important. Why is low inflation a problem for the ECB? First of all, it's a problem if you look at, these are all inflation rates. And it's Spain, Italy, Germany, and the Eurozone as a whole. And you can see, well, of course, in Spain and Italy, inflation, in Spain it's negative, and in Italy it's almost zero. But also in Germany it's below 1%. So if you want that the peripheral countries gain some competitiveness, you would need high inflation rate in the core countries and lower inflation rate in the peripheral countries. Now you've got low inflation rates in the peripheral countries, but unfortunately also very low inflation rates in the core countries. So a very low inflation rate in the Eurozone, which means, of course, in Germany, France, or wherever, inflation rate is also low, makes it very difficult for the peripheral countries to gain competitiveness, because you don't want them to be hit by a severe deflation scenario. So that's why ECB would be more glad with 2% inflation, 3% in Germany, 0% in Italy. So that would make a 3% difference. So easy for Italy to gain some competitiveness. But that's not the situation, and that's why the ECB is not really happy with a low inflation environment. And another very severe problem for the ECB is obviously interest rates, if we look at the bond market. So these are 10-year government bond yields. You see the US, blue, Germany, gray, and Italy and Spain, yellow and green. And this period here was at the middle of last year when the Federal Reserve the first time talked about normalizing its monetary policy. You might remember most of the emerging market currencies came under pressure at that time because the market was surprised. They said, okay, the Fed wants to hike rates. That would mean higher yields in the US. And of course, if the yields for US treasuries are increasing, you usually have yields increasing all over the world. And that was in fact the case. The yields in the US went up due to the monetary policy expectations, and we saw yields in Germany going up and also in the peripheral. So now the ECB has a problem. Because one of the triggers behind the European debt crisis has been the increase in yields in peripheral countries. And if the Fed is to hike interest rates, the ECB wants to avoid that yields in the periphery are also increasing. So they try to get some kind of decoupling, which is very, very difficult. We did some analysis with Japan and US yields, and you can see that it's very difficult to decouple from US rates development. You can only decouple from it if your monetary policy really goes into a completely different direction. And that's where the ECB is heading to. The end of QE in US, the start of QE in Europe, higher rates in the US, still the promise from ECB side to keep the rates very low in Europe. And you can see that after the ECB started all these measures and the forward guidance and the promise to keep it low, the market realized that lower yields in the peripheral are justified. So if you look at US yields for treasuries and for Italian and Spanish bonds, the yields are very close to each other. Now the question is, why is quantitative easing such a burden for a currency? Well, everybody knows that if the Fed started to buy assets, that was bad for the US dollar, and the speculation that the ECB will do it is a burden for the euro. Why is it? Well, a short explanation. What you see here is the yellow line is the monetary base, the Fed's monetary base. Monetary base is very simple. It's just cash US dollars, and money of commercial banks at the central bank's account. That's monetary base. So it's something which the Federal Reserve can control completely. And of course, if the Fed buys a bond and the Fed needs to pay for it, either there will be more cash, but perhaps there will be more at one of the bank's accounts within the FOMC. So this is the result of asset purchases. Now the second line here, it's called excess reserves. So this is the amount of money commercial banks keep at their account within the Federal Reserve they actually don't need for credits. Okay, so these excess reserves are, of course, the banks cannot be forced to hold excess reserves. That's why we call them excess reserves. Yeah, there are necessary legally reserves, and if you've got more, these are excess reserves. And you can see that, of course, if the Fed starts to buy bonds in a very aggressive manner, banks are not able to provide so much more credit. So all the stimuli, all the additional monetary base needs to end up in the excess reserves. That's why these two lines are moving in the same way. if you put this together, we need to talk about, so that's the reason why of course, QE is a burden. Yeah, just imagine if the excess reserves are increasing for the whole banking sector, there's no other way because somebody has the money on its bank account at the end of the day. And excess reserves in euro have a negative interest rates. Banks cannot be forced to hold it. So we've got a situation where at the one point, the whole banking sector has increasing excess reserves, but not a single bank can be forced to keep more excess reserves. So they need to do it on their own will. How they do it, of course, at the beginning a bank doesn't want to have more reserves, so they might just buy an asset with its reserves, which means that all asset prices are increasing. That's what we see. We see very low yields, high equity markets, and so on. So in relative terms, if all asset prices are increasing, the price for excess reserves is relatively lower, which makes excess reserves at the end more attractive. And now if you imagine that a European bank would buy a US Treasury to lower its excess reserves, it would have to sell the euro and buy the US dollar. That's why the euro will depreciate. That's why quantitative easing is a burden for a currency. Last point, and very important, is the behavior of ECB. When we talk about quantitative easing, the reason for the ECB to talk about quantitative easing is that the OMT program, which is all quantitative easing means buying bonds, government bonds. OMT means buying government bonds. So the action is completely the same. The problem is that the OMT program is something the ECB is actually not allowed to do. It's not in line with its statutes. The German Constitutional Court already decided that there is a problem with this. There will be a hearing at the European Court next month, and there is a good chance that the OMT program, like the ECB implemented it once, might not be constitutional. So they might not be able to run these OMT program. But as we already said, the OMT program is the reason why we have all these positive developments at the financial markets. Yields in the peripheral are only lower because everybody knows that the ECB will make sure that no country is running into default. So why not buying a Spanish bond with a higher yield compared to a German one if the ECB is guaranteeing that everything will be fine? But nevertheless, this OMT program has its price. Well, so the first thing we need to figure out is what actually means this OMT promise. Mr. Draghi said that they're going to do everything to preserve the euro. But how can the euro disappear? How can the European, the Eurozone break apart? I remember when I came into office at the day after Lehman crashed, everybody on the trading floor was trying to manage his things, and there was a lot of chaos, and everybody was pretty much surprised because nobody actually could believe that something like this would happen. But this is not a situation which can happen with the euro. We cannot come to office on the Monday morning and the euro is not there anymore. It's just not possible because it's our legal tender, and our parliament would need to make a decision that they change our legal tender. So the euro will be there. So how can the euro actually disappear? Well, the euro can disappear if countries decide to leave the euro. So Draghi needs to make sure that no country will decide to leave the euro. Why should a country leave the euro? It doesn't make sense for Germany. There are Germans, they complain that Germany is paying a lot, but it's worth, definitely. For the weaker countries, it doesn't make sense to leave the euro because if they would leave the euro, their new currency would be under such a severe pressure. They would depreciate strongly, they would create hyperinflation, so that it wouldn't be a success story. The only reason for a country to leave the euro is if the country is going into default. Because if you're going into default, and that's true for all European countries, the respective banking system would be in default immediately. Because usually the banks hold a lot of government bonds of their own government. So let's say a certain country is going into default, the banking system is not there anymore, it's not functioning. So for running your economy, you need a good functioning of a banking system. So what you actually need is you need to recapitalize your banking system. But in that situation, the ECB wouldn't give you any money. So what you actually need is you need to go back to your own currency just to be able to recapitalize your banking system. So that means Draghi needs to make sure no country is leaving the Eurozone, which is he needs to make sure that no country is running into default. And a country will only run into default if interest rates, if the yields they pay for their debt are too high. Just take the case of Japan. They've got interest rates almost close to zero. And they've got a debt to GDP ratio which is far above we know from the European debt crisis. I mean, Greece is now expected to have a debt to GDP ratio around 175%. Japan is far below 230%. But it's not a problem because yields are so low. The state never needs to pay back its debt, he can just roll the debt. So if you can roll your debt forever and you've got interest rate zero, your debt level just doesn't matter. And if you're very close to zero, it's fine. So it's not a matter of how much debt you have, but it's a matter of are your yields low enough for that debt level? So to make sure that no country is running into default, Draghi actually needs to make sure that yields in the peripheral will not be too high. That's why he needs this decoupling. So if we talk about the OMT promise, actually the OMT promise means I promise that I make sure that for no country in the Eurozone, the yields will be too high. And now, that's the last thing here, let's look at what this means. Everything is fine now, so there needs to be a price for it. Okay, so what is the price for this ECB approach? Well, we talked about that yields are very important if you want to serve your debt. So one thing, so I will put yield on the vertical axis. And we talked about the ECB buying government bonds. So I put intervention volume, that's the amount the ECB buys on the horizontal axis. And of course, there is a relationship. And it makes sense that there is a negative slope because the higher the intervention volume, the more the ECB buys, the lower the yield will be. So that's a very easy situation. And we might be at this point, intervention volume and interest rate. And now we have to distinguish between two situations. Well, first of all, this is a certain country. This is the setup. And now the finance minister conducts a bad policy. Let's say the finance minister decides to double the wages in the public sector. People will be happy, but financial markets won't. So there will be a shift of this curve to the right-hand side, which means for a certain intervention volume, yields will be higher. So this, because the risk premium of these bonds will be higher. And now we have to distinguish between two situations. The first one is the ECB decided that they have a fixed intervention volume. That's the case. This case was with a security market program. So there is a fixed intervention volume. What happens is in the new situation, of course, the intervention volume is fixed, so we once more go up to our respective line. We go over to the left-hand side, so we see the result of a bad policy is higher yields. The finance minister realizes, well, I spent too much money, so I have to pay more interest on my debt. The second point is if there is a yield cap, and that's why I explained a couple of minutes before that the OMT promise is actually a yield cap to make sure that no country is running into default. So the setup is the same. You know this situation already, okay? That's before the finance minister implemented bad policy. But we can already say that we are going into the opposite direction because we keep a certain yield level and just find out how much intervention volume is necessary to keep this interest rate level. Well, there is again a bad policy, but the result of this bad policy is a very different one. Now, to keep this yield level, this yield cap, the ECB needs to increase its interventions. So the result is just a higher intervention volume. The yield will be the same. So the result is governments won't feel the consequences of bad policy. So this is the price we have to pay for this OMT promise. And if you listen or if you look at the media, whenever ECB is talking, they always promise that they're gonna provide more liquidity. But at some point in their statement, you can always read they require more reforms. They want the governments to behave well. They want the governments to consolidate their budgets. But of course, finance ministers don't feel any pressure. So that's something which can be, the turnout or the result is still open. If governments start to realize that they need to implement reforms, even if they are painful sometimes, things will be fine. Then the OMT promise from ECB was just a genius idea. If that leads to a situation where governments feel that they can spend as much money as they want because the ECB anyway has to make sure that yields are not increasing, we might turn out in a situation where the Eurozone as a whole spends much too much money, which would have some implications for future monetary policy, but also for future fiscal policy, because money you spend today, you can't spend tomorrow. I don't have to tell you that. So, conclusion, yes, the OMT promise or the idea of quantitative easing works because it will keep yields low, but the incentives for European governments to consolidate their budgets are also very low. And this is very much in contrast to what we see in the US. In the US, you can see that, I know a couple of, two years ago, a very usual question was always, isn't the situation in the US as bad as in the Eurozone? Because they have a lot of debt as well. And they were running double-digit budget deficits. If you look at them today, they run rather minor deficits because they are very flexible and they have incentives to consolidate their budgets. In the Eurozone, we don't have these incentives anymore, at least not, I mean, there is some pressure, but it's much less than before the European debt crisis. So if finance ministers won't realize that they have to do it on their own, the ECB will be in a dilemma, because on the one hand, they would like to run an independent monetary policy, but on the other hand, they can't do it because they have to stick to their promise to keep yields low. So that's but from an economic point of view, of course, if you look at Germany, for example, yields or the ECB yields are too low for the German economy. So we might get even too much stimulus in the years to come, which might be fine for the very short-term economic development, but it might create problems in the years to come. Okay, I think that's enough. I hope it wasn't too complicated. And of course, if there are any questions regarding Fed, ECB, or whatever, I will try to answer these.
Thank you very much. So, are there any questions for Mr. Karpowitz?
From what I understand from your presentation, you think the low interest rates of Eurozone will be there to stay. Does that mean the value of the euro will keep going down?
Yeah. Yeah, we expect interest rates to remain very low for a long time. And of course, that has implications for the euro. If you look at the last ECB interest rate meeting where they cut rates, and that was a big surprise for the market, because in the meetings before, Mr. Draghi always said that we already reached the lower bound. So he was just like, that was an intended surprise for the market. And we were very much astonished. And at the same day in the evening, another board member of ECB gave an interview, and he explained that actually they were trying to weaken the euro. So a weaker euro is something the ECB likes at the moment. Well, you can understand it from an inflationary point of view, because lower euro means higher import prices, which would add some inflation. But it also creates some problems. In fact, we expect the euro to depreciate further against the US dollar. My target is 115 at the end of 2015. A discussion we have to keep in mind is now how much US dollar strength will the Fed accept? Because maybe some of you remember there was a finance minister in the 70s who said when he was asked by a foreign journalist about the strength of the US dollar, and he said, well, the US dollar is our currency, but it's your problem. So they actually never really did care about the behaving of the US dollar. But now we might have a bit of a different situation, because we have the ECB asking for a weaker euro. The Bank of Japan is actually doing the same. The Swiss National Bank already have a lower bound of the euro against the Swissy against the euro. There are in New Zealand, we got data last night that they were intervening at the market to lower its own currency. So Australia doesn't want to have a strong Aussie. So actually, we know all the story about China, who are trying to undervalue their currency. So it seems that all over the world, banks are trying to gain some advantages by just devaluing or keeping their currency weak. And of course, if that is if the appreciation of the US dollar would become too strong, we might have a new thinking within the FOMC. 2 weeks ago, the president of the Federal Reserve of New York, that's a member in the FOMC, he got voting rights, a permanent voting right. He mentioned that if the US dollar would appreciate too strong, that would have implications for their monetary policy. They would take that into account. So some of these, you can expect a weaker euro, of course. We expect that, but there will be also some limits, because, as I said, other central banks are trying the same. So our forecast would, of course, include a less weak euro against Japanese yen, for example. And the question is, how much US dollar strength will the US accept? So there might, it doesn't mean that the euro will completely collapse. But of course, that's why I said there is not too much priced in yet in the market.
Thank you. Any other questions? James?
Okay. Lutz, I'd just like to know your opinion. I thought that was a really good presentation. Do you think, as a currency manager, do you think the euro is, the euro skeptics, we should say, have been vindicated? The fact that the euro is not, don't have a common bond, right, like the US or Japan. Do you think the Eurosceptics have been vindicated and we're on a slow death spiral with the euro?
Well, I mean, it depends. I mean, the idea of monetary union in Europe was actually fine. And there are now people, the skeptical people, they argue that, of course, the project wasn't perfectly set up because there was a lack of political union as well. And of course there is, if you look at Europe currently, you don't see any development in the direction of European political union. It's rather the opposite way around. But if you look at the setup of the euro, it was a setup in terms of a monetary view. The ECB was actually just the idea was we keep a common currency and we provide a central bank which just makes sure that inflation will not be too high, and that's it. And this is we call it monetaristic view, and this could have worked perfectly. Unfortunately, we didn't really stick to our own rules, because the rules were also like, no country is allowed to help another one. Every country is on its own, so that means there will be competitive. There will be a lot of efforts to remain competitive, and we skipped all these rules. We skipped these rules with various SMP programs where we all buy I mean, if a Greek bank goes to its central bank and cannot pay back the money, the whole union will pay for it. Okay, so there is a lot of transfer within these. And also the OMT, or the quantitative easing, a common European bond, which would mean that we completely broke all these monetaristic rules we implemented. So if we just would have kept the monetaristic view of a monetary policy or of a monetary union, things would have worked perfectly. But so there were two possibilities. One is a monetary union with a political union, or a monetary union with a monetaristic approach. And both of them would have worked perfect. The first one wasn't realistic because there was no political union, but the monetaristic approach would have worked. But unfortunately, we didn't stick to these rules. So that's why, of course, that's why we face these problems. That's why we have to make sure that the governments have enough incentives to consolidate their budgets. If they don't, we're going to just have a too high debt level, a too weak euro, higher interest rates for all countries. So that would mean that the well-behaving countries would also pay for the ones who don't care about their debt level. Okay.
With the Spanish, Portuguese bonds, 10-year bonds lower than 2%,
yeah.
Right? Isn't it broken?
Yeah, that's because of ECB. I mean, that's just because the ECB promised to make sure that the yields in Portugal or Spain will not be too high for the government to easily service its debt. So for an investment manager, it's a very easy approach. I mean, or even for banks, if you look at the TLTROs now, 4 years. So where's the risk? Even if you get the money only for 2 years, you buy 2-year Spanish bonds, so you get a higher yield, you have your margin, and the ECB is still guaranteeing the repayment. So that's a perfect deal. So that's why you saw after the announcement of TLTROs, 2-year Spanish bonds dropped immediately to yeah, of course. Yeah. Okay. So, but that's why I thought it might be interesting for you to get an idea what is the price for it, and the price for it is what I showed on the last slide. That there is we are very close to a situation where we might get some monetary financing, some state financing by ECB, and that never works. Yeah.
Thank you. Can we have one final question, maybe? Yeah, please.
Yeah, my name is Forrest Zima from Salzgitter Mannesmann. Thanks for the great speech, Mr. Karpowitz. Earlier in the year, there were worries about deflation in the euro. And given the fact that the exchange rate is relatively low and that you predict that they will remain low, is that a problem in the rearview mirror already?
Yeah, well, inflation rate is very low. What is the problem with deflation, actually? I mean, if you look into an economic textbook, the explanation why deflation is a problem, it goes like, if everybody expects prices to be lower tomorrow, private consumption will be very low because nobody buys things today. Everybody's waiting for the next day, but next day he's waiting for the day after because prices are always lower. Now, if you go to Japan, where they had deflation for decades, you see they are. It's still a very modern country. So the argument that nobody buys if he expects things to become cheaper is not really true. So there will still be some consumption, but the point is inflation expectations. Yeah? If everybody expects prices to be higher and the actual inflation rate is below zero, that actually doesn't really make a problem. Now I showed that the inflation expectation, five-year inflation expectations, they dropped, but they dropped from 2.1 to 1.9%. So it's not, they don't signal deflation. And you can strip the inflation swaps also that you have in expectation always for 1 year. So 1 year inflation in 1 year, in 2 year, in 3 year, in 4 year, and 5. So if you do that, you would just see a line which comes from 0.5% at the beginning to 2% at 10 years. So people are not expecting inflation in Europe to turn into deflation. So from that point of view, the ECB does not really have a deflation problem. But the inflation argumentation is the only way for the ECB to make sure that the implemented measures are in line with a mandate. The ECB is not allowed to run a more expansionary policy just because they are concerned about the development at the labor market, like the Fed is allowed to. So the only way for the ECB is to argue with the inflation rate. So that's why I would say they create a picture which is a bit more pessimistic than I think it is justified. It's a political move. So there is not really a deflation danger in the Eurozone.
Thank you very much. I guess we have had a very good presentation, and thank you very much for your answers. So,
thank you.